Let's get across the market open. Kyle Ryder joining us from capital.com. Kyle, welcome back. Now, of course, all the focus being on Nvidia, that result dropping after the bell. What did we see?
Well, a pretty much spotless set of results. We're still waiting on the earnings call as we speak, but top line beat, bottom line beat, margins were higher than expected, and guidance pretty much smashed expectations for the quarter ahead. So you can't really fault the numbers as they're presented. The critical issue will be around this earnings call and the picture painted by the company, especially from the perspective of chip demand by hyperscalers going forward, and in particular the demand for the Blackwell chip and how that's sort of scaling up. But the notes that have been in the release by the company more or less suggest that there's a backlog of orders, that demand is very strong, that the Blackwell chip is pretty much already seeing excess demand. And the company is liable, obviously, to paint a pretty positive picture for its outlook. But once again, it's kind of exceeded expectations. The stock is up after hours, and that seems to be pushing futures higher too. So for now, it looks like a pretty solid set of results that investors are really buying into.
All right, so much has been hinging on that result. Look, also investors very much focused on what the Fed is likely to do next in the absence of data during the shutdown. So that's now coming through, although I see the October payrolls has been cancelled. The release of the November report pushed back to mid-November. That's actually going to come after the next Fed meeting.
So yeah, effectively the Fed's driving through a lot of fog at the moment, and we're going to have the updated jobs data more or less today, but it's going to be pretty stinky. It's 2 months old, and will obviously give some pretty important information about the labour market, but pretty old information. The markets are now pricing in a very good chance that the Fed won't cut interest rates in December. And in fact, we saw markets moving quite significantly on an intraday basis predominantly, and somewhat in response to the FOMC minutes. On the to reflect now about a 33% chance of a cut, so call it a 67% chance. 33% chance of a cut, 67% chance of a whole decision. That weighed on asset prices, risk assets through the session. It also gave the US dollar a little bit of a boost. And now, we've got a couple of data releases that we're really hinging pretty much the outlook for Fed policy on. Not so much the jobs data, because as we just said, it's going to be a little bit patchy, but the inflation figures that we get next week, which will either validate the concerns of those who were shown to be quite hawkish in the FOMC minutes and have come out quite hawkishly over the last few weeks, that inflation's still a problem, it's not going away, and it could rear its ugly head again next year, or it's not, and we can focus on what's likely to show a little bit of sluggishness in the labour market in the official data that we are able to get, not so much again in these figures that we're likely to get for September, but certainly those in months going forward once the data is to be sort of collected again and released to the market. So it's kind of a two-part trade at the moment in the markets. There's the AI tech theme, the overinvestment, the inflated valuations, that kind of thing that has driven some level of volatility. That looks like it's going to subside a little bit because of the Nvidia results this morning. But the other part of that trade is, of course, monetary policy expectations. What's inflation going to do, and how is the Fed going to respond? And that's going to be a sort of a lingering question still, and one that increasingly the markets are sort of pricing in will be something hawkish, and therefore something negative for risk appetite.
Yeah, certainly market sentiment has been negative in anticipation of those risk events being Nvidia. Interesting to see then, as you say, that futures are up. An interesting, gauge of sentiment has been Bitcoin. It has actually continued to fall.
Yeah, and once again, I think that a lot of the downside that we saw in a lot of markets last night, gold was another one that pulled back from its intraday highs too, and Bitcoin was through 90,000 again once more, is because of those rate expectations. And the US dollar looks a lot like it's bottoming out now and is going to push to potentially sort of a 6-month high or thereabouts, depending on the index that you're looking at. The US dollar index is about 100 at about 100 again, outperforming the G10 complex, and all indicating that markets are positioning for effectively tight financial conditions at the margins and potentially a flatter path forward for US interest rate policy. Bitcoin's a great barometer of risk appetite. Typically, you can sort of argue that the bear market and you could call that from a technical basis, because I think we've seen probably a 25% drawdown, a little bit more than a 25% drawdown in Bitcoin itself over the last month or so. That is, sort of a fire alarm typically for equities, perhaps a bit of an indicator of liquidity coming out of the market too. So really, if you're looking for maybe something of a forward-looking indicator of risk appetite and whether we're likely to get a sort of Santa Claus rally, it will probably come once Bitcoin starts to stabilize and maybe move higher. I suspect that will only come, again, based on the recent price action, if we get a little bit more confidence about the Fed outlook as well, and hopefully see some of that dovishness come back through in market pricing. But data dependent, we won't know that until obviously the jobs figures, but more crucially the next round of inflation numbers that we can get.
Now, Kyle, of course, you're in London, so I guess the most immediate focus over in the UK is that forthcoming budget, whereas here in Australia, pretty quiet data-wise.
Yeah, we'll get that next week, and it should be fairly interesting to see how the markets respond, because there was that little scare last week when it came to plans to not hike income taxes, that the UK would be heading to some kind of fiscal cliff, fiscal crisis once again. And we have seen at different stages over the last couple of weeks, that kind of very catastrophic mix of a falling currency, falling stock market, and a falling bond market over here, which really does scream a lack of confidence in fiscal settings, and by extension to that as well, the government, which is looking increasingly shaky too. When it comes to sort of local news, I think today is going to be all about digesting these Nvidia results. And actually, to start with, it looks like it could be a pretty good start to the session. A lot of risk and uncertainty will be taken off the table by these results. It won't completely get rid of the concerns about whether we are in some kind of an AI bubble, because arguably you wouldn't see the bubble like behavior or cracks emerging in Nvidia. Hyperscalers are probably the place to look, because they're the ones that are supposed to be monetizing this technology for the most part. But nevertheless, a bit of a relief rally does look like it's on the cards, and that'll probably sort of persist until we get to this jobs data tonight, which of course will be fairly critical, because it's the first update for an FPs that we get in a couple of months.